Hey everyone, I'm Jeremy Szafron, and this is Kitco News. Now, on today's show, Bitcoin's price action is making headlines again, but not just for its recent surge, but for its significant gains this year, signaling a potentially critical moment for cryptocurrencies. But it's not just the digital currency space that's buzzing. The foreign exchange markets are showing unusual patterns of low volatility, with carry currencies and the euro drawing keen interest from traders looking for those types of opportunities. Meanwhile, traditional safe havens like gold are navigating through their own challenges, with prices reflecting a market that's cautiously eyeing inflation and interest rate signals. And for equities, well, the market seems to be at a crossroads here, balancing on an edge of record valuations and pondering the risks of a correction. To help us navigate these topics, we're joined by Chris Weston. Chris has over 20 years of experience in trading and market analysis and roles at prestigious firms like Merrill Lynch, Credit Suisse, and Morgan Stanley, currently serving as the head of research at Pepperstone. Chris, thanks for coming on with us today.
My pleasure. Thanks for having me on.
Yeah, I appreciate it. I know you're in Australia, so thanks for making the time for us today, too. You recently put out a report that highlights a distinct momentum in Bitcoin, and I want to talk about this with a notable absence of high volatility. Now, with Bitcoin closing higher in 16 of the past 21 sessions, what attributes to this steady climb, and where do you think we're going here, Chris?
Well, I mean, all the conversations I'm having with clients at the moment is what time do we go and break the all-time highs that we got back in November 2021? I mean, one of the big issues that we had for so long was the regulatory risk. I think people are seeing that dissipating now. Probably people are saying the two big risks for some sort of decent drawdown of, I don't know, it was a decent drawdown in Bitcoin these days, 20% or so, is probably just either profit taking that manifests into something a little bit larger, or more prominently, some sort of macro shock like a resurgence of inflation concerns that completely reprices the rates curve coming through and then causes sort of broad cross-asset risks to roll over, the VIX to trade into 20%, and then perhaps some of these high beta assets, which of course I think is what Bitcoin is. It does have idiosyncratic issues that's driving the price at the moment, but I think in most cases a momentum vehicle that's a high beta momentum vehicle. So, I think they're the two issues. So I think people have sort of de-risked their situation, and I think what we've also seen is just good news after good news coming through, and obviously that's really impacting sentiment. And then you've got sort of mechanical flows. If you go and have a look at the sort of gamma curve in the gamma strikes in the options chain, I know it's a small part relative to other markets. It's just all upside call buying, and as price just trades through those call strikes, those fixed strikes, then obviously dealers are having to hedge their exposures. They've sold calls, they just want to be market neutral. And effectively, they buy the underlying. You've got CTAs who are buying futures. You've got ETF inflows. Obviously, we know about that. It's just a kind of Goldilocks scenario. Just a lot of people chasing right now. So I think you've got a perfect storm. The question is has it got a little bit too hot, perhaps? But I certainly wouldn't be short. I'd be either neutral or long at the moment. And I think onwards and upwards at this stage at the moment.
Right. I mean, obviously, you talked a little bit about it here, but we've seen the Bitcoin spot ETF approval. It's been a game changer with the inflows coming in, but there's also speculation around an Ethereum cash ETF. How do these developments affect the landscape here? And is it too late to jump on the bandwagon? Where are we right now?
I mean, I sort of represent the trading. I'm not a buy and hold person by any means at all. So I'm sort of more on the sort of trading side of things, and it really sort of depends on your strategy. I mean, I really like to deploy momentum and trend strategies, and right now Bitcoin's you've got to have it in your portfolio for those reasons. I think the Bitcoin Cash ETF it seems to be a bit of a game changer. I mean, we've seen $5.5 billion of net inflows coming through, and that incorporates the outflows that have come through the Grayscale trust, which was over 7 billion. So there's been a big inflows coming through. I think that does play not just into the adoption story with financial advisors having a compliant vehicle to push to their clients. And obviously, depending on the volatility, you can spread the risk within the portfolio, or diversification within the portfolio. The Ethereum ETF, I think people do see it as a matter of when rather than if. The SEC do have other constraints to work through, considerations than what we saw with Bitcoin, for example, liquidity, top line book liquidity and other factors such as that. But I think the market is saying, look, it's a matter of time. Perhaps it's going to come in May. And also you've got the halving as well. That's, you're going to be taking supply at the market essentially. And I know we've only had 3 different occurrences of a halving coming through, but obviously all of them have been very positive, 6 and 12 months afterwards. And so I think people are getting set for that as well. So there's just a lot of good news. I think Bitcoin and the whole sort of crypto scene works on a confidence game like financial markets more broadly. And, it's just good news after good news. The other factor is that, if you have a look at junk equity at the moment, high short interest stocks, poor balance sheets, there is a pretty high correlation with Bitcoin and with those as well. So some people are saying perhaps it's just a high beta move relative to what we're seeing there. So that if we were to see those places roll over, then maybe Bitcoin's got some downside.
Yeah, well, we're going to talk a little bit about equities, but I want to talk, and obviously Bitcoin halving coming up, but I want to talk a little bit first about the people that are buying Bitcoin. It seems that the diehards are not really selling here. Are people taking profits? You mentioned all this good news. We're up 4.27%. It looks pretty stable.
It does. And I mean, people say it's volatile. I mean, statistically, it's not that volatile. We've got a 30-day realized volatility around sort of 40% or so, which is well below the 12-month average. And I think, when you're looking at statistical volatility in Bitcoin, you are looking at those close percentage changes on a daily basis. And we haven't really seen the outlier move is above 5% on a daily close, which you go back into periods gone by, 5% was an attribute. People were seeing these massive daily closes. Now what we're seeing is just a one-way consecutive price. Price moves up, it consolidates, it breaks out, it holds the high, and it continues to find new buyers in that run. And that's what I love about it. It's just that the rate of change is good. The momentum's there, the trend is there, but we're not seeing massive statistical volatility by any means at all. And I think, for people who are looking at risk-adjusted returns, Bitcoin is still right up there with some of the best risk-adjusted returns that you're getting in any asset class this calendar year so far.
Mm-hmm. The upcoming Bitcoin halving has historically been a bullish event. Based on your insights, what can investors expect from this event? How might it compare to previous halvings? What are you keeping an eye on? I
mean, I think I'm going to put it out there. I'm a TradFi guy who just loves crypto as a trading tool. To be honest, I mean, spreads are a little bit wider. It can cost a little bit more money, but for the movement that you get relative to the cost to trade, it's fantastic trading vehicle. But look, I mean, going back to your point, the 3 halvings that we saw over the time. I mean, I'm just keeping an open mind. It's the only thing you can do as a trader is to keep an open mind and say, look, we've only got a sample of 3, which to any statistician is not relevant. It's noise essentially. But if we work on those case studies, the first one that we saw a number of years ago was huge, but it was obviously coming off a very early base. The last 2 were the percentage changes that we've seen in the 6 to 12 months afterwards have actually sort of been sort of 80% or so. Still fantastic gains, but it perhaps suggests that on the 4th occurrence, we may not see that sort of performance. It may do, we don't know. Right. But I think we've got a sample of 3, so we can't really hang our hat on it. But the question is when do you place the trade? I think maybe there's evidence that the market is front running that situation now.
Mm-hmm. It's so interesting to watch. We'll be obviously keeping an eye on that. We'll have the latest. You talked about traditional finance, so let's move over to fiat currencies, the FX markets. You've mentioned a preference for carrying currencies and the euro in this low volatility environment. Explain this to us and how traders might capitalize on these conditions.
Well, I mean, if you're trading euro dollar at the moment, it's a grind. The realized, the implied and realized volatility is multi-year lows at the moment. Certainly in euro dollar, we're a couple of 2-year lows or so in terms of 1 month implied realized volatility. So I mean, this obviously has implications for how much risk we take on the position, how our position size as well. And it's just got this kind of grinding notion that's coming through. And what we see is very, very low volatilities. And we're getting that across asset class. The move index in the bond market has been rolling over. We're sort of 108 at the moment. The VIX, as we know, had a bit of a it showed some life recently, getting up to about 16% post CPI. Then it sort of just pulled back to where we are at the moment, around 13.4%. You can go across asset class. I mean, obviously, a lot of your viewers will know that gold movement is very, very poor at the moment. And I think when you get this situation, you've got to deploy the right strategy as a sort of a tactical situation. And when you get these low vols, sort of grinding price action, and what we're seeing consolidating in equity markets at these highs, is you just want to get paid to be in position. So income strategies work well, and we're seeing carry as a strategy outperforming. So we are using the yen still as a funding currency in that situation. I know that we're going to come into March. We're going to have the spring wage negotiations from the government. I think that the Bank of Japan will be looking at very, very closely. We saw a slightly stronger CPI number, but it's still our preeminent funding currency at the moment. And I think in that situation, we are seeing some good buying and some better buying in some of the LATAM currencies. Certainly the Mex yen's breaking out at the moment. And also relative value strategies. I mean, if you want to know why euro dollar's rallying, I mean, the closest relationship we're seeing right now is the yield differential between 10-year real rates in Germany and what we're seeing in real rates in the US. So real rates, obviously, using the nominal treasury and adjusting it for expected inflation over the coming 10 years. And we've actually seen German 10-year real rates moving up as a yield on a relative basis against US. So that's putting upside into the euro, and that's what we can call that a relative value play. So yeah, in this low volatility environment, you've got to adapt, and the strategies that seem to be working right now are more income based on the carry side, and also on relative value there.
Right. You just pointed out some potential catalysts for a possibility of increased volatility across asset classes, like the upcoming US NFP. We got CPI, the PPI reports coming. How significant are these indicators in your analysis, and what are you expecting to see?
Yeah, I mean, March is going to be massive. I mean, we can go to China. We've got the MPC meeting coming at the beginning of the month. We've got Swiss CPI on the 4th, which for currency trades, very idiosyncratic. But if that comes out weak, it does open the door to the Swiss National Bank to be the first central bank to cut rates this year. I know we always think it's the Fed who lead us off, but the Swiss National Bank could feasibly lead us off, and the market's opening the door to a rate cut in March, which then makes the Swiss franc your preeminent funding currency going forward, and that has then cyclical reasons to be short there as well. I think the market will just go, right, we are just absolutely piling into Swiss franc short. So I think that's interesting there. Going to Ramadan on the 10th, is there the possibility of a ceasefire? Perhaps some people have floated that idea in Gaza. We've got Powell speaking, on the 7th of March at Humphrey Hawkins' testimony. We'll see there. But I think, what causes volatility out of all of the big macro has to come from US inflation dynamics. We get we'll have a look at the average hourly earnings as part of the payroll report. So I think it's the 8th. And then, a few days later, we get that CPI print. Now, obviously, everyone was saying in that 40 basis point core number that we saw recently, and obviously super core pushing up 85 basis points, that perhaps this is just a seasonal issue. It's a one-off. We'll have to see what happens in the February data. Now, if we were to see another, say, 40 basis point month-on-month on core, with services being strong, then I think people would say, look, okay, this is not great. We're going to have to roll back even further those interest rate expectations. People perhaps would ramp up their expectations that when we go into that Fed meeting later on in the month, I think that comes out on the 20th of March, we get the Fed meeting, that perhaps we could see a change in the dot plot. So the Fed may look to price out three cuts and put in 2. And then I think the market's very happy. I think volatility's happy to stay low. People are happy to sell vol and in spikes, as long as rate cuts are coming out of the market as a result of better growth dynamics. And we can roll into things like the Russell and small caps and various factors in that dynamic. But if it's the right tail risk that's causing anxiety, that we start to see inflation expectations on longer term, 5-year break evens, for example, pushing up, and we were then to see a bit of dollar buying and the rate of change picking up with real rates moving up, the market won't like that, and that will be the cue then, I think, to see the VIX pushing into 17-18%. People de-risk. Volatility begets high volatility. Systematic players just coming up the market. Volatility funds go more to cash, CTAs de-risk. Yeah, and so that's where it's at. I think that's going to be the trigger then. So really looking at that CPI print, if it's hot again, the market won't like that at all, I think.
Yeah, no, absolutely. I mean, it's been pricing in, as you mentioned, many more rates than the typical 2 that we're seeing now. I'm curious, turning to gold, which seems to lack a spark despite usual triggers like inflation and rate changes. Where do you see the opportunities for traders in this range-bound market?
Well, I mean, if you're just trading gold, you're just having to be really cute with the price action, take the time frames in, and you're just trading mean reversion moves, really. You're trading a range. Obviously, if you're an investor in gold, like a lot of viewers would do, I mean, probably the one thing I will say is I think given that we've seen 10-year real rates moving back into 2%, we've seen, beginning of the year, seven rate cuts now being priced into, say, 3.5%. And we've got the rates market pretty much bang on equilibrium with the Fed stops and the threat that we're going into what could be a more lively March. Of course, we look ahead as traders. I think the fact that we've got gold prices where they are, I would say that's probably a win in itself. I mean, you could probably argue it should be $50 to $100 lower based on those dynamics, but we know central banks are buying, private buyers are there at the moment. And obviously, we've seen a bit of a drawdown in terms of known ETF holdings as well. So you can make an argument that gold prices should be lower. So the fact is where it is definitely a positive in my mind. But yeah, look, I mean, if we were to see term premiums ramp up going into March, we talked about that. If we were to see the rate of change in terms of yields moving up across the curve based on a nominal real basis, and the dollar was to rally, then I have no doubt that we're going to see sellers playing through. But right now, everything's very calm. Just a 1 week, 1 month, 3 month implied volatility in gold. It's very, very low at the moment. You can have a look at risk reversals, which essentially look at the skew of call volatility minus the put volatility. And you can see that's just been sort of trading at 0.4, very, very neutral. So the options market is saying, we're going to get a move. We're not really sure where it's going to come from. We're not seeing a clear directional bias at the moment in terms of the moves. It's all very quiet on the Western front. As I say, I make an argument that gold prices should be lower. They're not. But we are coming into March, and I would do see the opportunity to buy volatility. I do see a bit more life, but again, it's going to come down really to what we're seeing in the rates complex there.
Right. Lastly here, let's talk about equities. You've mentioned that the market is hard to chase at these levels. We got an increasing two-way risk, basically. Can you elaborate on the factors obviously contributing to this sentiment, and where do you see potential opportunity or maybe some potential pitfalls?
Yeah, I mean, when I started learning to trade in 1998, I think my mentor was telling me at the desk was saying that, if you've got a market at all-time highs, you can't really get any more bullish than that. Forget about everything else. You're long or you're neutral, but you're not short. Unless the dynamics change. If you can see a much higher volatility playing through, obviously the order book's dynamics change. It's easier for short positions outside of intraday opportunities in that situation. But right now, pullbacks are very, very shallow. Yeah, the intraday ranges are very, very poor, are very tight indeed. And so I feel like that we're going to consolidate is kind of the base case, but obviously you can only trade what's in front of you and less about predictions. I will say that, I think NVIDIA still trades well. We're going into the GTC conference that comes out the 18th to the 21st of March. I wouldn't want to be short going into that. I know there's a lot of investors looking to see the product roll out there. And obviously we all know that NVIDIA is the epicenter of the markets at the moment. Its influence on semis and other AI names is not just in the US, but across the world is so there. So I think that's going to be a big one. I'll put that on the diary, the GTC conference for NVIDIA, because people will be buying, I think, in my opinion, into that conference. Maybe get by the rumor sell fact, we'll see. But I think a lot of investors want to see what happens into that. Obviously, We're watching that CPI number. But if we were to see volatility, pick up on a realized basis and implied, that's when I think we'll probably start seeing a greater chance of a roll down. It's going to come from those CPI prints. It's going to come from inflation dynamics. It's going to come from right tail risks. But react when we get there. Let's see the market, show us that it's time for a drawdown rather than get set for it now, because we've tried doing that. People have been talking about poor market breadth, concentration risk for ages. People talking about the falling dynamics of number of companies above their 20-day, and it's just giving you absolutely no edge whatsoever. So, I think right now it feels like it's consolidation, perhaps with a small upward bias.
Yeah, it's definitely an interesting equities market. And as we see AI touch everything, I don't think this is going away anytime soon. Is there any other specific sectors or maybe some types of stocks that offer safer haven or better growth prospects that you've been watching?
I mean, right now it's still the sort of the quality, good balance sheets, low gearing places that people want, and the pullbacks are offering buying opportunities. That's where everyone. I mean, home builders have been flying as well. You know, we saw the home prices last night. That still seems to be a good place to be at the moment. I think people are looking to buy pullbacks. Healthcare has been working really, really well. And again, that's just one that you want to be looking to buy dips in. And again, you know, all of these factors is there because the market just sees the Fed put very much in place. Anything derails this economy, the Fed are going to step in. I mean, they've got stuff to work with, the balance sheet. We know that they're very proactive with the balance sheet. We know it works. Liquidity saves the day every time, anytime there's kind of some systematic issue, a systemic issue, should we say. But yeah, I think they're the places to be. What I don't like is that I think that a lot of the junk stocks that have come through, a lot of these most short baskets that have had a very good run, and you know, I wouldn't want to be touching any of those right now. I know that's you know, something that we're looking at. As we go into March and all this event risk, I'd be certainly just laying off some of those exposures if you're in them. But yeah, again, just guided by volatility in the market. I think that's central to everything we're seeing. But yeah, I think all those factors still work. I still want to be leveraged to very high quality growth, good balance sheets, good return on equity. They're the places that I think have been working, and people will be looking to buy pullbacks and any kind of dips there.
Yeah, definitely a couple of haircuts and a couple of sales on for some of those equities. Chris Weston, head of research at Pepperstone, joining us. Chris, thanks again for coming on, breaking this all down for our audience. I appreciate you today.
My pleasure. Thanks for having me on.
And don't forget to subscribe to our channel and visit kitco.com for the latest. I'm Jerry Szafron. We'll see you next time.